Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-morning update for Tuesday, March 12th, 2019. I'll go through a few charts of some of the commodities I've been watching recently and roll into the broad markets. Really, I'll do the broad markets last because there aren't any new developments to cover since last night's update. But there are a couple long-term developments or charts that I want to just point out if there's time left in this video. So we'll try to keep this one relatively short. This is cotton. I'm still watching cotton for a potential breakout play. A lot of commodities have been held down lately due to the strength in the dollar, so we really need to see a pretty solid reversal in the dollar and steady pretty steady downtrend. And then I think a lot of these commodity ETNs or futures, which we're looking at here. This is cotton, by the way. CT is the symbol if you're trading cotton futures. And the big level here is 75 and this downtrend line. So you have the downtrend line, which you can see right there coming in, forming this bullish falling wedge pattern. There's your divergent low. All divergences across the board, nice and clean divergences, which I like to see. $75 is also resistance. So you get them, if we get a breakout in both, you can see the reactions there. It was support, 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 and then once support's broken, it becomes resistance. And so that's the level we've been tapping on. Need to break it out, need to break above this basing pattern, and so an impulsive break above both the downtrend line and the $75 level, which coming together should quote unquote should bring cotton up to at least this 71ish or 81ish level right there. It's a rough line, and possibly more. So that's one on watch. And let's look at the 60-minute chart on that. Okay, this is that same trend lines. I just zoomed down to a 60-minute time frame, so you can see it trying to lift here today. But again, you need to overcome that 75-ish level and the downtrend line. So a little bit of work to be done. Certainly one to watch. And BAL is the ETN if you don't have access to futures. And when you trade those commodity ETNs, limit orders are advisable. Unless you have interactive brokers, you can use what they call the smart algo adaptive orders, where you enter a limit order and then you entrust their computers, their algos, to fish you the best price. They'll kind of fish it between the bid and the ask and adaptively adjust the order to try to get you a better fill. So that's one other option other than limit orders. KC Coffee, it just, so far failure to launch right here. We had the breakout right there. Came in, back tested. It has that key level. Much prefer to see it get above and stay above the $1 level, but right now it seems to be catching support around 97. That's where we've had numerous tests to that 97ish level, and we're trading there now. So again, maybe this one's basing. This is a long-term support. Remember, that's why we added this one on. It's right at or around, maybe a hair below long-term support around that $99 level. Now we have this minor downtrend line to watch as well. So I'm not giving this one much rope. Whatever the official stop is, I'll have to check that. Hold on. Okay, here we go. This is the Joe trade. So we're still well above the stop. It's sort of a, so far a dead money trade. It's thinly traded, so I give it a little extra room on the stops. And we also have the potential to add additional targets if it takes off. So to try to replicate that near-term trend line I just had on the futures, you want to look at this if you're watching Joe. So there it is. We need to now take out this trend line. Ideally hold here, on or above that 3460-ish level. And again, you can see the targets here. And here's crude oil, crude futures. Crude is doing a lot like what the market did recently until it started to correct. It just, had an upward ascent, and then it's just been dead money. Crude has gone absolutely nowhere now for, what is this, going on a month? Yeah, a good month of sideways trading right here in this range. And remember, this is longer term resistance right here as well. So I pointed that out at the time back here, and so far that's capped the advances. And that's the story here, is it's been in a trading range. You've had pullbacks off that resistance, and it's hit it a couple times. We even had this as, I think this level is a target on a couple of those trades. And then of course you also have this uptrend line off the lows in December, late December. and breakdown, back test, move back down to the bottom of that zone once again, move back up. So all I can say is you're near the top of the zone now. Little upside before you back test if you zoom in really tight there. And here, let me give you a horizontal line right there at the recent highs. If I could grab that from over here, horizontal line tool, boom, there you go. Move it up just a hair. So that's pretty much the upper end of the range right there. You can see that would come in around the trend line as well. So this was resistance yesterday. I pointed that out, but we took that out. We started to come down. We popped above it. So now this is either a back test again, or that trend line there is the next resistance. Or if you break down below, I still think that's a significant level. It's about $57 right here. This line break down there could be the catalyst for move back down. And remember, this is crude stalling out at longer term resistances. And for you ETN traders, here's USO. This is a 60-minute chart. Here's that same uptrend line off the lows there back on the 24th, I believe it was, December 24th. And so, nice little clean wedge pattern, breakdown, back test. And if we push up a little higher, it would almost, at this point you're so close, it might want to make a run at it. Let me just show you a scenario. Whether make equal or higher, slightly higher high. You can see here we're going to have some divergence if it does that and then reverses again, which I'd suspect. So it could turn down here on the back test. It could creep up, back test a little more. Any equal or higher high on price. So that would be this high here on USO. Again, USO looks a little different because you don't have the round-the-clock trading like the futures. But doing so would give us another divergent high. The last time you had a divergent high on the 60-minute was right here. And that played out. That was good for a drop of, grab it there, down to the lows. That 60-minute divergent high played out for about a 7% drop. You can go 3 times that or better in DWT, but again, that's just leverage. You can do the same thing. You can buy 3 times as much USO to get the same profit, or short 3 times as much. And lest there be any confusion that a long or a short, as far as a longer term trend trade or swing trade, lest there's any confusion that is almost a direct play on the equity market. In other words, if you are long or short the S&P 500 and then you're long or short crude, you're overlapping that position, because right now, and usually, not always I need to say that, but usually there's a extremely high correlation. There has been. So these lines show you can see up here, SPY is in green, USO, the oil ETN is in white. Don't look at the difference in the lines, just look at the directions, and then one's going up, the other's going up. They both peaked right here, right there. They both went down, and they both rallied, peaked a little bit. There's some differences by days here, but not a lot. The overall trends, as you can see, are unmistakably, look, there's the meltdown last quarter, and they both bottomed on the exact same day, and they've both been doing the same thing, stalling out here recently. And of course you can zoom in a little tighter, and then you see the difference in lines. So remember, they're going to separate here because they don't move the same in percentage terms on a day-to-day basis. So you just look at the trend when you're doing comparisons and see if they're both going the same direction. So just food for thought too. And it comes back to position sizing, diversification, which I think is, I know it's critical to investing and trading. Okay, so now let's wrap this up with the broad markets, take a quick look at what's going on today. Again, I could give 2 flips what happens intraday. Let's see how we close the day today and tomorrow, and then heading into this, towards the end of the week, because that to me is more important than any 1 day or 2 day move in the market. Again, because I'm focused now largely on those weekly charts, looking to see if those weekly bearish engulfing candles are confirmed this week with a red candle, or at least a candle, like I said, on the majority. It doesn't have to be all the indexes, but the majority of the indexes, at least keep this week's candles down around half of the body of last week's candle, and the lower the better, to really firm up the bearish case, and otherwise to keep the bullish case alive and strong, to see those candles get taken out this week. In other words, if we close the week above last week's close in most or all the stock indices, then that's pretty darn bullish, because it's wiped out what could be one of the the best sell signals that we've seen really since last year. Sorry, IWM, it continues to be really weak, relatively speaking. It took it down on the chin. The drop was twice, I think, what the S&P was off the highs recently. So there's something going on there. And this is your old risk on, class. So it's showing risk off right now with the small caps. And the small caps, by the way, are still well off their highs. So there's no arguing they already had a bear market, by at least the drop here. And, it's hard to argue that, well, let's just try not to read too much into it. Let me just point that out, that even at the peak there, they were still 8% below, and right now they're about roughly 11% down off their 2018 highs. So, again, when you just look back longer term on a lot of these charts, it kind of gives you the big picture and so you can keep things in focus. Here's a wedge we had there, the breakdown, what appears to be a kickback rally so far, and then longer term for the small caps, they'll be largely dependent on whether the small caps will depend on if the large caps break down or not, or take out, I should say, going on to take out the December lows. And so that's a level to watch. So if we take out the December lows in IWM, you're also going to take out this long-term uptrend line. It goes to the left of the chart. This is 10 years of price history here. So here's our bull market uptrend line. It was tested back then. Also, pretty key support. And this is interesting too, guys. As I'm looking at this right now, it just made me realize, my targets, if we do take another leg down here soon, my next downside targets, if this is a bear market rally, which will then reverse soon, we'll have another sharp leg down, could happen, could have already started. We're not in any type of impulsive selling yet, but if that happens, my targets are right around here on SPY and QQQ. Here is that top of that trading range. This was, a drop of 20%, over 20% in IWM, but this was a multi-year sideways trading range right here in the small cap stocks. And those were the highs back from 2015. You can see the year breaks down here, and late 2016. And when you go to SPY and QQQ, it's not on this particular chart. I'll find you a clean board. Eventually I'll have one. That's also where I'm targeting if we have another leg down somewhere in there. So we'll call it from about 220 on SPY and down to here, probably favoring that lower number, about 212. So it's interesting to note that the small caps have already come and back tested that level. Large caps haven't done so far, and ditto for QQQ. Let's just talk long-term stuff for a minute. Again, we'll see how today closes and how the week closes. This chart was posted in the trading room by, well, actually, I posted this one. Flanny3 in the trading room posted an updated version. I posted this one back in, it would have been October, because this is the October data, pointing out that this looked like an imminent top here in margin debt. So margin debt, for those not familiar, so you go to your broker. When you have a brokerage account, a margin account, you can borrow against the value of your security. So a lot of investors or traders will use margin. Some use it for active trading. Some will just leverage up their account. So what tends to happen is after several years of a bull market, strong gains, people start to get more cocky, confident. And what they do is, okay, I've made 10% a year for the last 2 or 3 years in my S&P 500 index fund, for example. So why don't I just leverage that up? If I'm making, if the stock market is like, okay, my bank's paying me 1% interest or less, but I'm earning, again, mindset of some retail investor, so I'm earning 10% interest. It's not interest, but they might think that way. In the stock market, in the last 3 years, and it's going to keep doing that. That's what they tell me. Why don't I just leverage up? I've got, let's say 100,000 in there. My broker will let me buy another 100,000 in stock or mutual funds. So why don't I just borrow up, leverage up, and now I have 200,000. So I'm making effectively 20% a year on my money. And so what happens is that's the signature of a bull market top. Is you have these surges right here. I probably should use another color. Didn't realize that was blue. Let's go with a black line here. So you have this surge. You can see again the red line, margin debt, S&P 500's in blue, and you can see this surge. And I'll box it in for you. It'll look a little easier. And that's the signature of a bull market top. Margin debt's been rising along with stock prices, and at the end, everybody just piles in and says, you know what, this thing's going to go up forever. The Fed has figured it out. We'll never have a recession again. Bear markets are a thing of the past. Wash, rinse, repeat. Anybody who's traded long enough or studied history knows that it's a mass psychology of the of the general public, and that's what happens at the end of bull markets. So there it is, and again, we had it right here. Nice surge up, you can see, leading up to the peak back in October. This, we had a similar ramp up here, and I think that would have been the top. Of course, I think history was rewritten when Trump took office, because the markets were expecting a Hillary win. We started a roll over there. So let's fast forward to today. Okay, here's the chart that Flanny3 posted. This is the updated chart of margin interest and margin debt. You can see the sharp drop off. Now that is another signature after that sharp run up into the highs. Again, this is where I posted it back in October. Then you have a very sharp, almost equal move down. So that shows you a bubble has been popped. This is what we call this market top. Some people called it the housing bubble, but a lot of people, myself included, called it, it was really a credit bubble. That's what it was. And a credit, of course, was part of the home loans in there. So that is, again, a signature of a bull market top. That final, sharp ramp, and then a nearly equal drop off is that margin debt becomes unwind. And remember, I talked about that into October, as before we even hit the lows, as before we even really rolled off the top. I said you will see, because of this, and that's why I posted that chart. The reason the sell-off was so severe last quarter, it was the unwinding of the margin bubble. When people have, they're maxed out on margin and they're long, the vast majority of investors at all points in time in the market are longs. So when you see this chart, this isn't short interest ramping up. I mean, there are shorts in there, don't get me wrong, but the vast majority of investors are long. So when you see the, the credit bubble go the other way, once it pops, once a bubble pops, it's popped. That's it. If it's not popped, then this is just a corrective wave like that was back here. But like Bitcoin, once a bubble popped, there are kickback rallies along the way, but a bubble's popped and it's popped, and that's it. And it can take many years, usually does, sometimes decades or more, before that asset, if ever, even reflates into another true bubble. So again, this is where we're at now. Only history and time, I should say, time will tell if we're going to see if we're right here, right now. A little kickback rally with the stock market. And again, it sure has the all the signatures, and the only difference is this debt bubble is a lot bigger than the previous one and the one before. That also makes sense over time. Remember, there's more people in the world, there's more money in the financial system, especially with the Fed printing all the money, all this global central banks. This is quantitative easing has created a lot of extra money in the system that wasn't there before. So therefore, you're going to see a larger peak. However, you also sets the way for a larger drop. I think I'm in the boat with a lot of people. I think we're looking at a Japan lost decade type scenario. So you can Google that if you're not familiar with Japan's lost decade. It's technically 2 lost decades, but you can do a web search on it. So that's that. And the other thing before I leave this chart is you can see the shaded boxes are recessions. So you might say, okay, Randy, well, that makes sense maybe, but you know what? I don't see that shaded box here. 2 things to that. Number one, and first and foremost, recessions are only declared in hindsight well after they've started. It is considered, the technical definition is 2 negative quarters of GDP growth, 2 negative quarters. And GDP is reported on a quarterly basis, so that's 3 months. You have Q1 GDP, which we're in Q1 now, will be January, February, March. Month of March ends, and then it's still a month before that's even reported. So now you're talking data that's up to 4 months old before the time it comes out. The March numbers will come out, the end of March, so Q1 that is, and I'm sorry, April, and even then it is almost always, if not always, revised in hindsight. So what'll happen? In other words, this line didn't appear back then. It was only put on this chart afterwards, where the government said, okay, we're in a recession, the numbers are official, and then you revise the data back after the fact. So these lines were pretty much added after the fact, is what I'm trying to say. So we won't know when the next recession hits, if it's going to be this, or if it's going to be over here again. So don't count on that. The one thing you can count on is that by the time that it's official, that it's in the papers, it's on the media, that we're in a recession, the U.S. has entered a recession, is the stock market will probably be down 20% or more at that point, because it is hindsight, lag time, after the fact kind of stuff. So again, this is just one of many charts that help to speak to the bigger picture of where we're probably at in the economic cycle, and in this particular cycle with margin debt. So again, thanks Flanny3 for sharing that. And one more again from Flanny3. This one was put up last night. Flanny3 mentioned this at least, and then I did this chart. Going back, looking at a quarterly chart on the S&P 500. Now, a quarterly chart means every candlestick, up here quarterly, each candle represents 1 quarter or 3 months of price action. So I usually only go out once in a while, look at quarterlies or annual charts, but for the most part I'll go out to the monthly charts, because they're just such slow. You don't hardly have any changes in the quarterlies unless you're really you're in a bear market and you can clearly see what's happened. Now you can see with this quarterly chart, here's the trend lines, there's your bull markets, and to me, I mean, this chart is just I'm sorry, it's just so flippin' clear, but this takes long time. These are quarterly candles, just like I talked about GDP. Well, this current candle is still being worked on right now. Won't be finalized. The green one that we're on right now. I took this yesterday, but it doesn't matter. Again, because it's quarterly. That candle won't be finalized to the end of the month. It's March 12th. A lot can happen between now and March 12th. This candle can look like this, or it can look like, this. You're going to have the top of it and the bottom no matter what. So it's either going to look like that, or it can look like this. If it looks like that, get out of Dodge with your longs, because that will be, you can already see this chart. I mean, again, it speaks volumes to me. You can see very clean, well-defined bull market uptrend lines here, and not very many red candles are rare. Big red candles are even more rare, like this one that came last month. Where do you see those big red candles? Well, you usually see them in a bear market. Once in a blue moon. This was a pretty nasty correction. Here's one, but this came early in a bull market. When you get them after many years of gains in a bull market, you see a candle, big red candle this size. You won't see one going back until you get back here. So, or well, by the time we had one that big, it was right here. So here's my point. You have the uptrend lines again that show you, where the bull markets ended in the past. This is the dot-com bubble right here, 2000, the 2003. Bottom. There's the Great Recession, the bull market or bear market from October 07 to March 09 right there. And here's our super long bull market uptrend line right there. Smashed through with a big red candle so far, still trading below it. And then this is what Flanny3 had pointed out. I mean, we're going back to the 80s here. This is over 2 decades. It shows your last, bull markets in recent history. Half the people listening to me right now probably weren't alive before the bear market before this one. So you can see with 100% accuracy, and it's a small sampling set, but Flanny3 said you can go back to, I think, the 80s or whatever and see the same thing. I just pulled this chart because it's 2 decades. There it is, bearish PPO crossover. The PPO line crossing the signal line. And surprisingly, one reason that the long-term charts, monthly and quarterly and yearly charts, aren't super effective are very useful for timing your entries and exits, because by the time they tell you the trend has changed to bullish or bearish, usually there's been a huge move, 20-30% or more. But I'll tell you, when I look at this one, I mean, it nailed the top right there. The top was a previous candle. So almost for a quarterly chart, did a dang good job of saying, boom, bearish crossover, welcome to the new bear market. Bullish crossover came late, and that's the thing. These sell signals came much more timely. You can see there's the top right there, this red candle, the following candle, and again, this crossover wouldn't be effective to the end of the month. So I'm going to say that. Yeah, but at that point, there was the end of the month right there, and it was still a very timely signal. Especially, this is where long-term investors, 401k money, that type of stuff, wants to pay attention to. So again, back here, this is where again I think we had one of those very rare things where the fundamentals trumped the charts, no pun intended, and that was the Trump win in the elections. The markets had not factored in a Trump win. Well, I won't say very few people. I know he had supporters, so won the popular vote or whatever. But or maybe I got that backwards. But either way, the charts were changed. They were poised to make a bearish cross, but they didn't. So that was not a whipsaw signal. In fact, anytime you're moving using a pair of moving averages, or in this case a PPO with a signal line, the signal line will often act as or the main line will act as support or resistance, and that's what happened. So it kept the trend bullish at that point. So did this. Well, I use this really on the monthly. That's that 20 month. I use it. It works better on the monthly chart. But that's it, guys. You can see. So I put a question mark here because once again, the lines are kissing. They kissed back here. They haven't made a cross yet, but guess what? They've only kissed right here. Other than that, when you start to see the momentum roll, you get the crossover. You can almost look at it and guess what's going to happen once you're heading down to that level. And so I'll tell you this. Let's keep it simple. We'll know in today's March 12th. So we've got a few weeks to go, not even. And we'll know at the end of the month if we have a clean bearish cross on the PPO. And if so, that just puts one more check mark in the longer term case that this was a bear market rally. But I'll tell you, where we're at right now in the daily charts and the weekly charts, I believe if we're going to roll over, we need to roll over soon. If we close the month in March strong, it's just, it's going to, it'll kind of doesn't fit well with the narrative of a bear market rally. This thing is pushed the upper limits now. Anything is possible, but I think it would have to turn down pretty soon, and most likely before the end of the month. Okay, we'll just conclude with the broad markets. This is a weekly chart of SPY. Nothing much to update since, like I said, the biggest thing was last week's candles. Let's see how we close this week. It's intra-week now, so not much matters. But as each day goes on in the week, and if we continue up higher, then that's just more to fade before the end of the week. So we just can't extract too much right now. And I'll give it to the bulls if they can undo this. If they can close, the markets close above last week's candles, what that will have done is just really eliminated a potentially very bearish, fairly high probability sell signal. Again, the sell signal itself doesn't come on the bearish engulfing. To me, it comes on the follow through, the confirmation that you get next, the following week, and especially the week after. So this is yet to be seen, so we can't spend too much time there. But this is a bigger picture and breakdown, back test, and what I'm really watching now, as I was back in October and September, is QQQ and the tech stocks. So this is just one board of QQQ, many different draws here. Find one that, well, let's look at XLK and then we'll wrap it up, because that is pretty much QQQ. Here's XLK. You had these clean trend lines here, smaller divergences that lead to corrections. These are just corrections, and they're tradable ones within an ongoing bull market. And it's these big primary trend line breaks that are really most significant. So you had another one here, and so far a kickback rally, the initial kickback rally. Rarely do you see this. Usually corrections are going to be at least an ABC. We haven't had that. Three-wave corrective wave, and we've also had unusually this type of price action here is indicative. I remember back before the flash crash happened, it was at 2010. watching some experienced floor trader had been around forever, and he had mentioned something, seeing something similar leading up to like Black Monday 1987. This was right before the flash crash happened, and I noticed it too. The market walking up in this steady, almost unnatural. When I say unnatural, look at all the. You see the red, green, red, green, red, green, even in an uptrend, and back forth, back forth. This is how the stock market or a sector or stock usually goes up, even if it's an uptrend. This is unnatural. It's almost as if the algos, like I used the analogy on the way up. Remember I called it Russian dolls? You have bigger and bigger, smaller and smaller candles. It looks just like Russian dolls there. And again, I saw that. I've seen it a few times since. I saw it when we go back to, let's look at QQQ leading up to the highs back here. Let me get rid of all these things. Here's where I've noticed that. Again, back in the flash crash and a couple times since. You see these unusual all green, very small price compression candles, and boom, a big red candle right there. And these weren't made, these were small pattern. This was a much smaller pattern, but boom, look at that sharp drop. So this is where the out of nowhere big drops come from. And of course, I remember clearly watching the market just go up in an almost unnatural, unsustainable advance in January, leading up to the January top right there. And that was followed by this. So we're seeing that now in the weekly chart, particularly in XLK, which again, if you're going to focus on only one sector, if somebody said, here, you can trade, I'm going to, but here's the conditions. You can only chart one sector. It would have to be XLK. It is by far, almost 60% of QQQ technology, and it's by far the largest sector in the S&P 500. And so that's why I was hyper focused on it back here, waiting for it to break, and said, when tech breaks, market breaks. And so the same thing right now. We have, going back to that XLK, it's doing great recently. It's doing great the last few days. It's really led this surge up here. But again, off the lows, especially when you look at it on the weekly chart, that's what we're looking at. So there it is. It's trying to take and undo that bearish engulfing. The week is not over, but right now, that's just doesn't help the bearish case at all to see it trading there. But let's see how we finish the week. But longer term, when I step aside, and I don't want to put too much, I'm not going to downplay the significance of these bearish engulfings, but it's not everything. And again, this is the bigger picture here. Big, long, well-defined uptrend line breakdown. Kickback rally so far. Trend indicator still bearish. That's this white line, the 9 EMA. There's a lot that you can go either way right now. There's no arguing the current trend off the bottom has been bullish, and until we get some additional confirmation sell signals, and that's what I'm watching. So just as I was back here, that's where it all started. Again, in October, I said when tech breaks, the market breaks, and that was it right here. There was your sell signal, and that certainly did it. So tech broke. It broke technically. It was a technical breakdown, very well defined. It started the whole thing. Other stocks resisted. Tech led the way down in the beginning, and then everything else followed. And again, so that's where my focus is right now. Let's see how the day closes. All right, this has been Randy Finney with the right side of the chart. I hope